Okay, we'll continue discussing. This is segment 2 of chapter 7. Now we go to installment sale of shares of stocks. The rules to determine the amount of tax due are the following. First, we have to determine if the initial payment is 25% or less than the of the selling price. So this should be 25% or less. Then capital gains tax may be paid by installment. If it is more than 25%, the initial payment is more, then it cannot be paid by installment. It's good as a cash sale. Secondly, if sale is not a mortgage sale, the tax due shall be based on the proportionate ratio of the installment payment received over the total selling price or to the total contract price. So here we have illustration. Mr. Pat has the following data transactions. Purchased 5,000 shares, and the cost of the shares sold is 200,000 pesos. So in terms of the sale, the selling price is 250,000 and the down payment is 20% and 2 years to be paid. Okay? To be paid equally in 2 years time. So now we will compute the tax due. Compute the capital gains tax. Simply we get the selling price of 250,000 minus the cost of the shares sold, then times the rate. In this transaction, the selling price is 250,000. It's right here, minus the cost of 200,000 pesos. That gives you 50,000, and times the rate, which is 15%. That gives you a capital gains tax payable of 7,500 pesos. This is due for the sale of the shares of stocks. But this 7,500 pesos is going to be paid by installment. By how? So on the first year, the payment would be 1,500 pesos. And the second and third year would be 3,000 pesos each. How is that computed? So total tax due is 7,500. Then we get the proportionate of the payments made. For the initial payment, it is 50,000. This 50,000 is the no, this is not the initial. This is the this is the initial payment, which is 20% down payment. So 20% of 250,000 is 50,000 pesos. So 50,000 pesos divided by the selling price, that gives us 1/5. So 1/5 of 7,500 is 1,500 pesos. On the second year, the capital gains tax payable of 75 is multiplied by the installment payments, and accordingly the balance of 200,000 pesos is paid equally in 2 years. So equally in 2 years, so 200,000 you divide it by 2, then that gives you 100,000 pesos right here. So 100,000 pesos divided by the total selling price. So that gives us the capital gain tax to be paid in second year of 3,000 pesos. Now since it is equal payment, so 2 years time, so second year and third year would be the same, equal installment also. So if you add all the capital gains tax paid for the first, second, and third year, it will give you 7,500 pesos right here. Yeah. So that is how installment payments for capital gains tax is computed. Now, if the installment sale is with unpaid mortgage assumed by the buyer, meaning there's a loan by the seller, loan which is contracted by the seller, but it is going to be assumed by the buyer of the shares. So assume further, uh, this is in continuation of the example. So we assume further that Mr. Pat here has an unpaid mortgage of 225,000 pesos, and plus the cost of shares sold is 200,000, and then the mortgage assumed by the buyer is now 225,000. So the terms of the sale is that the buyer is going to pay 300. It's going to the purchase price. I mean the selling price agreed is 300,000 pesos, and the initial down payment is 50,000 pesos, and the remaining balance is 2 years to be paid in 2 years equal payment. So compute the tax due. We have to get the capital gains tax payable. So in this case, then there's a mortgage, unpaid mortgage. If you remember in our computation, I think it's somewhere like interest. No? So we get the selling price, 300,000 pesos, minus the cost. This is the cost here, 200,000, times the rate. So in this transaction, the capital gains that Mr. Pat made is 100,000 pesos. Since the cost is 200,000 pesos and he sold it for 300,000, and we multiply it by the rate of 15%. So if you will ask where is this 15% coming from, this is from the train law, the law itself. So 100,000 times 15% equals 15,000 pesos. So for the initial payment, we will compute how much is the initial payment made. So it is computed by getting the down payment and then adding the excess of the mortgage over the cost and divided by the selling price. So the excess of mortgage over the cost is the mortgage assumed by the buyer minus the cost. So here we replace with numbers. Down payment is 50,000. The excess of mortgage over cost is 225,000 minus 200,000. This is the cost. Then divided by the 300,000 selling price in order to get the percentage of initial payment. If it is more than 25% or 25% or less. No. Because if it is more than 25%, then the capital gains tax payable should be paid at once. Is one. It cannot be made by installment. So we get 25% from this formula. So since it's 25% exactly, then it can be paid by installment. This 15,000 pesos. So how do we compute now? So we have to get the contract price. The contract price is computed, the formula here is the selling price plus the excess of mortgage over cost minus the mortgage assumed. So selling price is 300,000 plus the excess of mortgage over cost, which is 25,000. We have it already here. Or 200,000, 225,000 minus 200,000. Here, 225,000 minus 200,000 equals 25,000. Then minus the mortgage assumed. which is 225,000 pesos. So if you do that formula, then you get 100,000 pesos. This is the contract price. Then we get the annual installments. The formula is selling price minus mortgage assumed plus down payment, then divided by 2 years to pay, because this is the uh, this is part of the terms of the sale. 2 years to pay. You know? So if the selling price is 300,000, then you minus the mortgage assumed, and then you add the down payment 50,000. So then you divide it by 2 years, because it's to be assumed by 2 years or equally made in 2 years. You get 25,000 and then divided by 2. Then for each year, the payment is 12,500 pesos. Okay, that is the buyer of the shares of Mr. Pat. Only 12,500, because there's a mortgage assumed by the buyer. So now we compute the payment of the capital gains tax payable. So how much should be made? How much should be paid in the first year? So the first year we just prorate, no? So we get 75,000 minus 100,000 pesos times 15,000 pesos. Okay, so that gives us 11,250,000 pesos. Where's that? Oh, so the first year total payment made is 75,000 pesos. Why? Because the down payment is 50,000 and the excess of mortgage over cost is 25,000. So if you add this both, 50,000 plus 25,000, it gives us 75,000 pesos. Then divided by the uh, payments, total payments to be made. The total payments to be made would be 100,000 pesos. You know? How did I get 100,000 pesos? Of course, 300,000 minus oh here 100,000 pesos. This is the contract price. So 75,000 divided by the contract price gives us 15,000. Times 15,000 gives us 11,250 pesos for the first year. And that is the capital gains tax to be paid. And the second year, the remaining balance here, 12 for 2 years is 12,500 divided by the contract price and times the uh, capital gains tax payable. So it gives us 1,875 pesos to be paid in the second year. And the third year will be the same, no? Since it is equal payment in 2 years. So if you notice 75,000, if you add this one, 75,000 plus 12,500 and another 12,500, the total is 100,000 pesos. That's the contract price. So if you add all the payments, the total capital gains tax payments will be equivalent to 15,000 pesos. The same as here, but it is paid in installments. Okay, let's go to short sale of securities. When does it happen? It occurs when a speculator sells securities which he does not own and postpones their delivery to a later date. When the purchase price of the securities is it's lower than the amount he received from the sale in order to make a profit. But should the price of the securities go up, then he incurs a loss. For example, Mr. Marl, a speculator of securities, you get 120,000 pesos to buy 1,000 shares for Mr. X. So actually the story is, make it understandable, Mr. X gave Marl 120,000 pesos in order that Marl will buy 1,000 shares. No? So we don't know what company is this 1,000 shares. Let's say, for example, shares from PLDT. No? Okay. So because Mr. X knows that Marl is a speculator. So if the fair market value of the securities becomes 110 pesos per share, and Marl purchased them and delivered the same to Mr. X. So when he purchased it, when Marl purchased the shares, it is lower than the amount paid by Mr. X. So then he gains on the short sale. So capital gain is computed by selling price minus the purchase of securities. So selling price is 120,000 minus the purchase price of 1,000 pesos, 1,000 shares times 110 pesos per share. So that is 110,000 pesos. So the capital gain is 10,000 pesos. But if the fair market value of the securities went up, let's say 125 pesos per share, then Marl incurs a capital loss of 5,000 pesos. It's computed as selling price of 120,000, and purchase of securities is 1,000 at 125 or 125,000. Then the loss is 5,000 pesos. Let's go to wash sale. Wash sale is a sale or dispossession of stock or securities where substantially identical securities are acquired or purchased within a 61-day period. And the time here is beginning 30 days before the sale and ending 30 days after the sale. So beginning the sale 30 days before, and after the sale 30 days after. So substantially identical securities indicates that the stocks or securities of the same class or similar under important features, like bonds, where the only difference is the date of maturity. So here are examples of transactions or of securities not substantially identical and therefore not subject to wash sales. Exchanges of common stock to preferred stock and vice versa. The voting stock to non-voting stock, vice versa. Or stock of one corporation to stock of another corporation. So it's not identical, so it cannot be a wash sale. In bonds of the same corporation that differ as to interest rates, interest payments, dates, and dates of issuance and maturity, or one is secured by mortgage and the other is not. So this kind of examples, there can be no wash sale. So what are the requisites of a wash sale loss? Now, in order that the sale or securities is considered wash sale, the following requisites must be met. First, the sale of stock or securities is at a loss. Then within 30 days before or after such sale, the seller acquired by purchase or exchange substantially identical stock or securities. So the seller acquired after the sale, no? 30 days after. 30 days before or after. So it could be before or could be after. So the seller is not a dealer in stock or securities. So Note, even if the seller is a dealer in securities, if the transaction was not made in the ordinary course of business of such dealer, there is still a wash sale. So how do we treat losses and gains from wash sale? The following rules shall be observed related to losses and gains from wash sales. So first, losses and from wash sale are not deductible, while gains from wash sale are taxable. So only gains are counted. Now, if the number of securities sold is more than the number of the securities purchased within the 61-day period, then a no loss shall be recognized on the acquisitions within the 61-day period, which are matched with the number of shares or securities disposed of. So there can be no loss. Or letter B, a capital loss shall be recognized on the number of shares or securities disposed of, which cannot be matched with acquisitions within the 61-day period. So if the number of shares or securities disposed of cannot be matched with the acquisition within the 61-day period, then there is a capital loss, no? That can be recognized. Third, if the number of shares of the number of securities sold is less than the number of securities purchased within 61-day period, then the stocks or securities disposed of will be matched with the equal number of shares of stock securities acquired in accordance with the order of acquisition beginning the earliest acquisition. So formula in determining wash sale loss. Non-deductible loss is equals to the number of shares bought during the prohibited period and the number of shares sold times the amount of loss. So to determine the tax basis, this is the cost of the reacquired shares, then the cost of acquisition, add the wash sale loss, which is non-deductible loss, then that's the tax basis or the cost. So as an example, Mr. X had the following transactions in ABC Corporation's ordinary shares classified as capital asset. So he has the same shares, no? For the same shares, there can be wash sale, and he is not a dealer in securities. So on January 10, 2000 something, he purchased 10,000 shares at 50 per share, 500,000 pesos. On January 20, the same year, he purchased again 4,000 shares at 50 per share for a total amount of 200,000 pesos. Then on February 10, same year, purchased again 3,000 shares at 48 pesos per share. So there's now a decrease in the value of the securities. So that is 144,000. Then on February 14, 2000, same year, he sold 10,000 shares at 45 pesos per share. So it has this is taken from his purchase made on January 10, 2000, same year. No? So 10,000 shares sold here on February 14. So there's a loss of 5 pesos per share, 450,000. So how do we compute the deductible and non-deductible loss on February 14 sale, or the new cost of January 20 and February 10 purchases? And if on February 25, Mr. X sold 4,000 shares at 60 pesos per share, and how much is the capital gain? So this is another problem. So we first compute the first one, deductible and non-deductible loss on February 14. So this is the formula again. Is equals to the number of shares bought during the prohibited period and the number divided by the number of shares sold times the amount of loss. No? So first, the answer is 50,000 pesos. Of course, the sale made, uh, you know, this is the capital loss. No? The sale minus the cost of sales is there is a loss of 50,000 pesos. So how much is the non-deductible sale? So 50,000 pesos times 7 divided by 10 of the wash sale. That gives us 35,000 pesos. And deductible loss is 50,000 times 3 over 10, and that is 15,000 pesos. So 7 here is taken from the number of shares purchased, no? During the prohibited period, which is the one purchase on January 20 and another purchase on February 10. So 4,000 plus 3,000 equals 7,000 pesos. And the number of shares sold is 10,000 pesos. So it's here in the formula here. Number of shares bought during the prohibited period and the number of shares sold. So number of shares bought is 7,000 and the number of shares bought is 10,000. So if it's 7 divided with 10 and you multiply the capital loss. This is now the wash sale. No? Non-deductible loss of 35,000 pesos. In the meantime, the deductible loss is the difference between the two. No? 7 minus 10 equals 3. So this is deductible loss. 3/10 of 50,000. So, or simply 50,000 minus 35,000 gives you 15,000 pesos. Since 35,000 is non-deductible, meaning what is deductible loss is the remaining. So 50 minus 35 equals 15. Okay, second, the new cost of January 20 and February 10 purchases. How do we compute? So number 2 is computed by adding the original cost from the deductible loss. No? Okay, so on the original cost is 200,000 pesos, which is here, 200,000 pesos. So the one purchased on January 20 is 200,000 pesos. And the one purchased on February 10 is 144,000 pesos. Then we add the non-deductible loss of for January 20 is 35,000 times 47 because January 20 is 4,000. Oh no, yeah, 4,000. And the total purchase is 7,000. So that's 20,000 here. So the new cost of the purchase, the shares purchased in January 20 is 220,000. For the shares purchased on February 10, the new cost is 159. Or you add the non-deductible loss prorated, which is 15,000. You add it on the actual cost. So the loss is added to the cost, no? Because you cannot deduct it from your gain. Okay. So the loss is added to the cost. So the cost here now is higher. No? It's bigger because of the loss of the wash sale. Number 3 question, if on February 25, Mr. X sold 4,000 shares at 60 pesos per share, how much is the capital gain loss? So 4,000 shares, how much is the remaining? He has 7,000, no? So 4,000 would be taken from the January 20 purchase. So this is January 20, 220,000. So if the new sale on February 25 was at 60 pesos per share, simply multiply it by the number of shares to get the selling price of 240,000, and minus the new cost of sale of January 20, which is 220,000. You deduct it here, and that gives us a capital gain of 20,000 pesos. So to summarize the application of wash sale, the 61-day period is the prohibited date. No? So in this period, there are similar shares acquired within the 30 days period after the sale. And this is the before the sale. The date of the sale, similar shares were acquired. So loss is non-deductible, but gain is taxable. So in this case, the February 25 sale is taxable. But the loss here of 50,000 on February 14 sale is non-deductible. It is so the non-deductible loss is distributed to the cost of the remaining shares. Okay, let's go to liquidating dividends. What are liquidating dividends? This happens when the corporation is in the process of dissolution. So it's going to close. So it's going to distribute all its assets in full dissolution. Then the gain realized or the loss incurred by the stockholder, whether individual or corporate, is taxable or deductible from capital gain, as the case may be. So example, Mr. Conrad Mapalo invested in Benguet Corporation by buying 5,000 shares at 50 pesos per share. If Mr. Mapalo received a total amount of 300,000 from Benguet Corporation upon its complete liquidation, then the determination of taxable gain would be the amount received of 300,000 less the cost of shares surrendered, and there's taxable gain of 50,000 pesos. Now, if Mr. Mapalo received a total amount of 240,000 instead of 300, upon its complete liquidation, the determination of deductible loss would be 240,000 minus cost of 250. Deductible loss is 10,000. What is the deductible loss? Meaning it can be deducted from the gross income of Mr. Mapalo. Okay, let's go to own share received in exchange of property. For property, meaning there's own shares and then it is sold or exchanged with another property. So this is made by the corporation who issues the same share, or has its own share as its stock. So when a corporation receives its own stock as consideration for property sold or for payment of indebtedness, then it may give rise to a gain or loss to be computed as though payment has been made in any other property. So the issuing corporation gets back its own share as payment of debt by the person who's giving back, or in consideration of a property. So there's a property of the corporation, and they're selling it in exchange for the stocks it has previously issued. So additional assessments obtained by a corporation from its shareholders represent additional price, and they are not considered as income. To illustrate this own share received in exchange for property, assume that AAA company received 2,000 shares of its common stock with a par value of 50 pesos per share in exchange for a computer with a cost of 100,000 pesos. So the corporation here has a computer and it's going to sell it. And instead of receiving cash, it received its own shares. And the number of shares received is 2,000 shares, and the value of each share is 50 pesos per share. So 2,000 times 50 is equivalent to 100,000 pesos. So same, same as the computer acquisition cost. Okay, but the fair value of the common stock at the time of exchange was only 60 pesos per share. No, it's higher. So at the time of the exchange, the value of the share has increased to 60 pesos per share. So there's a gain of 10 pesos per share. So how do we compute the taxable gain or this transaction? So the basis of the amount received is the fair market value of the common stock. It's not 50 but 60. So 60 times 2,000 gives us 120,000 minus the cost of the property which is given up. That's the computer, and the value or the acquisition cost of the computer is 100,000 pesos. So there's a taxable gain or capital gain of 20,000 pesos from the exchange. So this would be subject to the normal income tax since the computer is used in the business. Okay, let's go to sale of treasury stock. What are treasury stock? These are these are corporations' own stock that has been previously issued and then reacquired, subsequently reacquired but not cancelled. So the sale of the corporation of its treasury stock may give rise to a taxable gain if the treasury stock is subsequently reissued for a consideration, meaning it's sold again, more than its cost. So a deductible loss may be incurred if the treasury stock is subsequently reissued for a consideration less than its cost. Example, assume that AAA company reacquired 100 shares of its common stock and a par value of 100 pesos per share for 15,000 pesos. So 50 shares were subsequently reissued at 180 per share. So it has reacquired 100 shares and the par value of each share is 100,000 pesos. 100 pesos. But its acquisition cost is 15,000. So, and then 50 shares were reissued, so meaning it is sold at 180 pesos per share. So there's a gain, of course, it's higher, no 180. So assuming that the shares were traded outside the stock exchange, the taxable gain on the reissuance of treasury shares or treasury stock is computed as follows. The consideration received is 180 per share times the number of shares, 50 shares, so it gives 9,000 pesos. So how much is the cost for 50 is the cost of treasury stock is 15,000 pesos purchased or at 150 pesos per share times 50. So that's 7,500 or 15,000 pesos times 50 over 100. So there is a taxable gain or capital gain of 1,500 pesos. Okay, let's go to sale of corporate bonds. Asa ka? Okay, the issuance of a corporation of its bonds at face value does not give rise to gain or loss. The gain or loss is recognized when the corporation issues its own bonds at a premium or a discount. The recognition of gain or loss, however, shall be based on the amortized premium or discount over the life of the bonds. So you know what are bonds? Bonds are floated when a corporation wants to borrow money from private persons. So instead of the private persons buying stocks, they would be buying bonds. But these bonds is like a certificate. It's a certificate of indebtedness, utang. So in the future, the bonds will be, they will mature in the future. So the corporation will pay that private person. So instead of going to banks, the corporation simply will float bonds. But this has to be approved by the BSP, Bangko Sentral ng Pilipinas. And in the part of the private person, he earns interest, no? Because bonds are uh, should earn interest. So, example, a corporation issued a 5-year 1,000 bonds with a face value of 1,000 pesos each, and for a 110%. So the bonds have 12% interest per year. So there is a interest rate of 12%. It's a very high interest. No? So usually the bonds they only have like 4%. So the computation of gain or loss on bonds issuance would be, so how much is the cost proceeds? So 1,000 bonds, face value of 1,000 each for 110. So multiply by 110. So 1,000 times 1,000 each times 110%. So the cash proceeds is 1,110,000. So minus the face value of the bonds which is only 1,000 each. So 1,000 times 1,000 is 1 million. So the premium on the bonds is 100,000 pesos. And divided by the number of life of the bonds, 5 years, then there is recognized gain every year, or the year of issuance is 20,000, no? Divided by the life of the bond, which is 5 years. And when the bonds will be retired on maturity date, so in this example here, maturity date is 5 years, there would be gain or loss on the bond retirement if they are retired before its maturity date. Say the corporation has already enough money to buy the bonds or to pay for the bondholder. So based on the illustration, the previous illustration, this one, A corporation's bonds were retired 2 years later. So only 2 years later, no? And at 105%. So the gain or loss of the retirement would be the face value of the bonds, which is 1,000 times 1,000 or 1 million. Then redemption price is at 105, so it's 1,050,000 pesos. So there is a 50,000 loss on retirement of bonds. Then the unamortized premium, which was because the premiums to be amortized, right? This one. So it should be amortized every year. 20,000 per year. Since there are already 2 years past, so because it's after 2 years, then there are only 3 years left. So 20,000 times 3 gives you 60,000 unamortized premium. So you deduct it. The premium is the gain, while the loss is here, the discount. So net gain on retirement of bonds is 10,000 pesos. Still has a gain. Interest in partnership. So when a person is a partner, he has interest, and that is his capital. So there will be gain or loss if he sold it at less than the value. No? So example, Mr. Tador, his capital in the partnership has a book value of 100,000 pesos. Then he sold it at 50% of his interest to Mr. Watusi. So only 50%. So meaning only 50,000 pesos worth, but he sold it for 80,000. So there's a gain of 30,000 pesos. Computed that proceeds from the sale of interest is 80,000, but the book value of interest is 100,000 times 50%, that's 50,000 pesos. So capital gain is 30,000 pesos. Very easy. Okay, let's go to dispossession of real property by an individual. So real property consists of immovable property such as land, building, and other permanent structure attached to the soil. The disposition of real property made by individuals, estates, and trusts and domestic corporations shall be taxed according to the classification whether or not the property is used in trade or business. So disposition of principal residence. So we are now going to discuss the sale of a principal residence. So what is a principal residence? It is a family home of the individual taxpayer. It refers to the dwelling house, including the land on which it is situated, wherein an individual, including his family, permanently resides, or whenever absent, wherein the said individual intends to return. So it is the residential address of a natural person, as certified by the barangay chairman who has jurisdiction over this place, or the building administrator. So if the residence is a condominium or the individual taxpayer's address as indicated in the latest income tax return. As a general rule, the sale of a principal residence is subject to capital gains tax of 6% based on the selling price or the zonal value, whichever is higher. And there's also assessed value, whichever is higher. But there are exemptions. So first, if the proceeds from the disposition of principal residence are fully utilized in acquiring or constructing a new principal residence within 18 months from the date of disposition, date of notarization, then the transaction is exempted from the capital gains tax, subject to the following conditions. Number one, the historical cost or adjusted basis of property sold is carried over to the new principal residence. Then, number two, the commissioner is notified within 30 days from the date of the disposition of the taxpayer's intention to avail of the tax exemption. Third, tax exemption can only be availed of once every 10 years. Fourth, an utilized portion of the proceeds is subject to capital gains tax of 6% based on the portion of gross selling price or the zonal value, whichever is higher. And this is the formula. Taxable amount equals unutilized selling price divided by the gross selling price times the gross selling price or the zonal value at the time of sale, whichever is higher. So the tax of the unutilized portion shall be paid within 30 days after the expiration of the 18-month period. Okay. So for example, assume that Mr. Conrad Valex, this is the author, sold his principal residential house costing 6 million for 10 million pesos. If he has informed the BIR commissioner within 30 days of his intention to avail of tax exemption and he utilized the entire 10 million to construct a new principal residential house, then the sale would be tax exempt. However, if he utilized only 8 million in constructing a new principal residential house, then the balance of 2 million shall be subject to capital gains tax computed as follows. Taxable amount 2 million divided by 10 million, which is the uh, contract price, and then times the 10 million pesos. Actually, it's the same, no? It's 20%. So 2 million multiplied by final tax, the rate is 6%. So that's the capital gains tax, 120. So notes, although the proceeds from the sale of residential house and lot are used to purchase a new house and lot as requisite for transfer of title, the seller is still required to deposit in escrow the equivalent amount of 6% capital gain tax in an interest-earning bank deposit. So such deposit could be withdrawn upon presentation of a release order from the concerned RDO after verification that the proceeds from sale were actually utilized in the acquisition of a new residence. If the individual taxpayer fails to submit documentary evidence within 30 days after 18 months from the date of sale to show that he has fully utilized the proceeds of sale, exchange, or disposition of his old residential principal residence to acquire a new principal residence, he shall be treated deficient in the payment of his capital gains tax. Accordingly, he shall be assessed for the deficiency capital gains tax plus the related surcharge of late payment and interest per annum of 12%. It's no longer 20% but 12%. This is the old law, no? So the note says that if Mr. Volex, because he is required to deposit in his crew account in an interest savings deposit bank account, the 6% of the total amount, which is the selling price, the 10 million. No? If he cannot show within 30 days that he has purchased or constructed a new residential house, then all of his the deposit that he has made, the escrow account is in favor of the government. No? Then it shall be taken by the BIR. And he will be subjected to deficiency capital gains, the related surcharge of late payment and interest. Okay. So assume that instead of spending 10 million, Mr. Valex actually spent 15 million in constructing his new principal residence. So what is now the basis of the principal residence? 11 million. Computed as follows. No? Basis of the old present disposed 6 million. Additional construction cost incurred. So cost of construction is 15 million. Entire sales proceeds is 10 million. So that gives us 5 million, then 11 based on the new principal address is 11 million. So it's only you can automatically or directly get the amount by knowing the cost of constructing. So actually it's so if it is 15 million he has spent, then there's additional 5 million. No? because he previously, based on the example, Mr. Valik's uh, old residential house costed him only cost 6 million. So if you deduct these two here, it gives you 5 million. So 6 million plus 5 million difference is equivalent to 11 million. Oh, it's the same. Okay. Now let's go sale or exchange of real property which are not used in business. So this is a capital asset transaction and hence subject to capital gains tax. The sale or exchange of such real property would be based on the selling price or the zonal value, whichever is higher. And the rate is 6%. And the form to be used is 1707. So a sample, Mr. Eric Fear acquired a portion of land costing 1.5 million. The land was not used for business and subsequently he sold the land to Mr. Froilan Limco Kauko for 1 million. Oh, I can't see. However, the zonal value of the land is 1.2 million. So how do you compute the capital gains tax? It will be based on the value of the zonal value. So here, the zonal value is higher than selling prices. So it's based on the zonal value, 1.2 times 6%. The capital gains is 72,000 pesos. So the payment of tax shall be on per transaction basis. So the computation of tax disregards gain or loss of the sale or real property. So the 6% capital gains tax of sale or real property is a final tax and not a creditable tax. So despite there's a loss, if you deduct the cost from the sale proceeds 1.5 minus 1 million, there's a loss. But still, it is subjected to capital gains. It's, an irony, no? It's there's an irony because even though there's a loss, there's still a tax of capital gains, even though there is a capital loss. Understand? So if the land is owned by a religious order, and if it's sold, then it's subject to capital gains tax. The following are not subject to capital gains tax: those which are under land reform program or exchange of real property for shares of stock original issued, and error in selling of lot. So there is error of sale. Or if the property is not used in trade or business, only the selling price, not the zonal value, shall be used in determining the basis of the tax when the property is foreclosed by the banks or sold by government corporation. So there's no zonal value to be considered, only the selling price for foreclosure or sale to the government. So let's go to sale or exchange of real property which are used in business. So if it's used in business, then it is deemed as an ordinary transaction. No. So accordingly here it says that it is not a capital asset transaction but an ordinary asset transaction. So this transaction therefore is subject to normal tax and not capital gains tax. So these are the following rules to be observed. If the real property sold or exchanged is classified as inventory, then the gross selling price or fair market value, whichever is higher, shall be subjected to creditable withholding tax. So meaning the buyer is going to withhold withholding tax, and the buyer will remit it to the BIR. So first, where the seller transfer is exempt from creditable withholding tax in accordance with the BIR. So if the seller is exempted, then there's no need to withhold. What are the exempt? Here is the exempt, no? Land reform. Oh, these are not. This is capital gains, no? Still land reform. Letter B, upon the following values of the property where the seller transfers is habitually engaged in real estate business. So with a selling price of 500,000 or less, so the withholding tax is 1.5%. With a selling price of more than 500,000 to 2 million, then the withholding tax is 3%. But if the selling price is more than 2 million, withholding tax is 5%. The seller transfer of real property classified as ordinary assets is subject to creditable withholding tax, which shall be withheld by the agent or the buyer. So such tax withheld shall be remitted to the BIR. Creditable tax is not a final tax, so it can be deducted from the year-end income tax due. So let's say, for example, the buyer has remitted withholding tax of 10,000 pesos. At year-end, the seller has uh, income tax payable of 50,000 pesos. Then you minus or deduct the withholding tax of 10,000. Only 40,000 is due to be paid. No? Of course, you have to get the certificate of tax withheld from the buyer. Okay, that ends our chapter 7. Actually, it's chapter 7. So, for any questions or clarifications, email me. This is included in our final exams. Maceren and macerenlaw@gmail.com, or my FB account, Attorney Lyndon Mac. And everybody have a good day, and see you in the finals.